The latest Fed minutes show policymakers will be patient for some time, even with inflation far below target. Quite a contrast to market bets on a 70% chance of a rate cut this year. We're back with Scott Thiel of BlackRock and Jeffrey Yu of UBS. Scott, what does this mean for Treasuries?
Well, I mean, I think it's worth reflecting on the Fed minutes for a second, right? So sustained economic growth, strong labor market, and inflation that as a transitory element but close to target. That's the way they describe their outlook. Obviously, that's a very patient outlook, and I think the market is obviously reacting to geopolitical noise, reacting to this discussion around an insurance rate cut around the transitory low prints in inflation. But our view is that the Fed will be on hold here, and so it's a little bit too aggressive. I understand why the market prices that way because of what's happening geopolitically, but from a fundamental perspective, it seems stretched.
Okay, well, when do Treasuries or bonds start tracking equities again?
Well, what we've seen is that they've this risk parity issue, so that they really have a good balance. Yeah, and so when we talk about portfolio construction, we like to own Treasuries because of the balance that they give you, and I mean, the last couple of days a very good example of that. But I would say that it does look a bit extreme now in terms of the amount of easing priced in, given the fundamental situation, particularly what we got yesterday, which is a relatively right from the horse's mouth, as they say, what the Fed thinks about the economy.